All right. Good morning. Welcome back here to Trader Minute. Great to have you aboard. I hope everyone's having a great holiday season and staying safe and enjoying the time of year. It's an interesting time of year when it comes to the markets, and we are definitely seeing more upside pressure out there. In general, but a lot of mix in things here, as expected. But want to go out and talk a little bit about day trading here today because we're starting the next challenge with the new year, and then next week on the 2 days that the market's open, Monday, Tuesday, to end the year, want to go out and just do some live day trading here with you, and in some live day trading sessions. And so I wanted to hop on, kind of show you what I'm going to be doing, and so we'll kind of discuss all the mentalities behind it, then we'll go out and execute it. No, I was asked after we announced what we were doing on those days, how many trades I'm going to be making, and it was 20, 30, 40, and my response was, whoa, no, like two or three, right? I'm not going to be sitting there going out and just trading every moment, right? I am not a hardcore day trader. I never will be. I never have been. Now, when I was learning the markets, one of the first books that I grabbed, I was in a Barnes and Noble, and I grabbed a trading book, and it was before the days of penny spreads. It was back when stocks were quoted as 50 and a quarter, or 50 and a half, or 50 and three quarters, and so things traded on those fractions rather than 50-25 or 50-26. Shortly after that time period, they went to penny spreads, and this whole book was about taking those fraction spreads and using them to your advantage and pulling out a quarter on each trade. And it sounded great. I read the book. I was so excited. I'm like, man, I got this. I'm going to nail this. I'm going to go out and I'm going to conquer the world. And here we go. And yeah, it wasn't very effective. When you applied that theory to real life and real time trading, it just didn't work. Right? The theory was fantastic. The theory really worked. But once you applied it, it just, which is what a lot of day trading is out there. And over the course of my career, that's what I have found. I'm constantly, approached with, "Hey Jeff, I'm doing this day trading. What do you think?" Blah blah blah, and then they start to send me stuff, and it all of a sudden doesn't work. Right? It's just one of those things where the methodologies of it are a dime a dozen. There are a million methodologies when it comes to day trading, but applying them to a real time market is a whole different ball game. And many of the methodologies that are out there are applied to virtual markets or theoretical or back tested, right? And it's done on markets where you don't have a live order coming in. Where you don't have that a human making a decision-making process or going through a decision-making process, right? And so they lack a lot of substance once they get to them. Now there are some that effectively day trade and do so very well. In fact, there are some in our community that are very good day traders and who do that for a living, and it's something that can be done. I'm not going to be speaking to day trading for a living. I'm going to be speaking to day trading as far as I do it, right? Which for me, it's a casual thing. It's something that I enjoy doing every once in a while. And there are two ways that I go about it, and I'll show you those two ways and kind of how we take them. The first way is by observation, different observational techniques, and I'll talk about those today. Tomorrow, I'll talk about more systematic techniques, applying technical indicators and in and out and very more algorithmic type entry and exit from day trade. But today I'll show kind of what I do mostly, which is observation techniques. I look for certain things to happen in the market. When they do, then I react to them. But before we get to that, need to talk about what's needed to day trade, right? You don't need a lot. You need your basic tools, right? So your high-speed internet, you need your your phone or your tablet or your desktop. So I'm just going to put in here basic tools that any trader needs because you need those, right? You don't need 10 computer screens. You don't need 50 pieces of software. You don't need just infinite information bombarding and coming at you. Some people like having all that stuff, but to day trade effectively, you need one screen, you need one technique, and you need some discipline, to go with those basic tools. And that's where this kind of discipline and plan come together. Right? If you don't have any discipline when it comes to day trading, you're going to get in trouble very, very quickly. It is not going to be a fun experience, and it is something where a lot of people, will say, "Hey, I have the discipline that's needed to day trade." Then they start to day trade and they get caught up into it. And the two big things that people get caught up into, we'll talk about when we get to the mentality, but it is something where that discipline is absolutely needed. And it's needed in all types of trading. But if you're undisciplined when it comes to day trading, you get yourself in a lot more trouble and a lot faster with that. So you need discipline and a plan to go about it. The other thing you need is $50K in your trading account or permission from your broker to day trade. You'll notice a lot of accounts that are under 50,000 will have a number of day trades used in the last week, and they'll give you up to 3 before they kind of shut your trading down and say, no, you can't trade anymore. Within this time period, right? The U.S. government has decided that they know how to protect the traders, and that if they're day trading too much, they need to shut them down to protect them from their sells. And it's a pretty arbitrary, pretty dumb rule in so many aspects, but U.S. government knows best, knows what to tell us to do, and unfortunately, that's in that. But if you have an account over 50,000, that's not an issue. It doesn't matter. Or if you have permission from the broker, that doesn't matter. Now, this is one of the reasons why next week when we do our live day trading, I'm only going to make a maximum of 3 trades, right? Because I know that many of you that are going to be on with me are going to be in that situation, right? And so in terms of live trades, I'm just going to make 3 at max, right? And I'm only going to make trades if they set up, but 3 at max there, because the challenge account, well, it's not over 50K, so it's one of those where I will have that limitation here as well. The last thing you need is something to trade. Something to trade, right? It's one thing to go out and day trade stock, right? It's a whole different beast to go out and day trade options. But whether we're talking stocks or options, we need liquidity. Liquidity is number one, right? If we don't have liquidity, getting in and getting out is going to be impossible, right? If I'm going in day trading, like let's pull up an option. Let me come in here. Let's pull up Triple M, for example, and let's say I want to day trade Triple M, and I'm looking at the options, and it's $1.25 to $1.35, $1.34 spread, right? And I'm going to buy it at $1.34, and the stock goes my way by 50 cents, and I'm selling it at $1.30 because I have to sell it on the bid. Right? If the spread between the bid and the ask is very large, then I'm not going to be able to trade, right? And the reason the spreads on the bid and ask are larger is because there's not as much liquidity, right? If we go look at the SPY, you'll notice the spreads are a lot tighter. They're a penny, right? Here on the option, 63 cents, 64 cents, right? It's a lot tighter, so there's more liquidity, there's more volume going through, so the spreads are going to be tighter, and we need that, right? We need those spreads to be tight in order to go out and trade, because we're going to have to get in, we're going to have to get out, which means we're dealing with the spread twice, and if that spread is high, that's a double hit. Right? Here's Triple D. You may love the stock Triple D, love day trading Triple D, but if you want to go apply options, the bid's 41 cents and the ask is $1.30. Good luck getting in, good luck getting out, and you're just not going to be able to get in real life at a decent price in and out. And as you go and you look at day trade techniques, this is one of the first ways you can kind of look and go, wait a minute, this is theory, this isn't real practice. Because they'll use stocks like Triple D. They'll go, yeah, see, we'll get in, we'll just buy a call option when the stock's at 9, and then we'll sell the call option when the stock's at 9.20. And we'll make that, 20 cents, which on the option was a good, 30%, and, we're home run. Well, then you come look at the option spreads and you go, wait a minute, there's no way you can execute that in real life, in real money, monetary terms. And that's one of the big ways. You can filter out 50% of the day trade stuff that's out there. It's just by looking at the option spreads of the stocks that they're talking about. But let's say you're just going to trade stock. You're just going to day trade stock. Well, you do have to be wary of the spreads as well. But most stocks, the spreads, they're decent. They're not going to be too crazy, and you'll be okay. But you need the liquidity. You need the liquidity. You need to be able to get in and out of the trade without paying big spreads, whether you're talking about stocks or whether you're talking about options. Now, 20 years ago, that meant a lot smaller pool of instruments that you can day trade. Now, today, the pool is huge. There's so many different things you can day trade. You can day trade General Electric, Bank of America, the SPY. You can day trade all sorts of ETFs, all sorts of various stocks out there. There are hundreds and hundreds of possible things to trade. As liquidity has gone up, and as a lot of the spreads have really fallen in a big way. So, something to trade has kind of gone from a game where you are limited to a handful of things that you can day trade, to now you've got to create some limits because there's almost infinite number of things that you can go out and day trade. But this liquidity factor is a huge factor, and so whatever you're going to day trade, make sure it has the liquidity. It's easy in, easy out, and you can run here with that. Okay. Second thing I want to mention is the day trade mentality, right? Trading in many ways is a mental game. Right? There's the execution, there's the strategy, there's the there's the timings and the when do I get in, when do I get out, what does this mean? They're all that. But when it boils down to it, you can have everything else, but if you don't have the right mentality, you're in trouble. And when it comes to day traders, right, there's often a mentality that is, what is the next trade? You say, well, no, that's not a big deal. What's the next trade? What's the next trade? Well, there's a big difference between that mentality and saying, hey, is there a good setup? Oftentimes, day traders will get themselves in this mode of wanting to predict everything or having to catch every move. Regular traders are like that too. You got to catch every move. You got to catch every move, because if you don't catch every move, then you're doing something wrong, and you should have the tools to be able to predict what this stock is going to do in the next 24 hours and then what it's going to do 24 hours after that. And it's a false mentality that traders get themselves locked into, right? When it comes to day trading, there's just so many more moves. You're looking at it under such a microscope that this negative mentality, or this what's the next trade mentality, can stack upon itself in a big way and get you lost very, very quickly, right? When it comes to day trade, for me, it is about, is there a good setup? No? Oh, okay, great. There's a good setup? Go. Oh, there's not a great setup? All right, I'll wait. No big deal, right? And it's not about predicting every move. It's about saying, hey, is there a good setup there for me? And that's the mentality that kind of keeps me, when it comes to day trading, just keeps me grounded, keeps me from getting, too locked into it. But, it's one of those things where I'm often asked, hey, Jeff, what's the next trade? And I always push back on it. I'm like, I don't know. I'm waiting for the next good setup, right? What's the next trade? That mentality, can destroy a day trader very quickly. Is there a good setup? That's the mentality that a day trader needs, whether they're going with observation techniques or systematic techniques here. The other issue that day traders run into is this kind of whole conflict between long-term and short-term, right? How often do day traders get into something and it starts to go against them? It hits their stops or something, and they go, well, you know what? The daily chart looks really good. Maybe I should hold this. Man, this weekly chart's really nice. Maybe I should hold it. Man, this monthly chart, maybe I should hold it. Right? And what do? They start taking a day trade that they used minute charts or 5-minute charts to enter. And now they start justifying holding it based on a daily, weekly, or monthly chart. You probably see where that gets you in trouble pretty quickly. The biggest problem that day traders have with doing something like that is it locks up their capital, right? Especially for those that are trading stock. It'll lock up your capital, and so now you're not able to, take advantage of the next 10 trades that come because you're holding on to one trade that you just don't want to take a loss on because, you say, the long-term, charts look good. And so they get this kind of cross-up, mix-up between long-term, short-term. They're entering on long-term, or they're entering on short-term signals. They're justifying holding based on long-term signals, and that can get day traders in a mess very, very quickly, and something where we can oftentimes see long-term traders, right, who will say, well, you know what, I got this because I was going to hold it for 6 months, but I got to move over the last 2 days, so I'm going to take it, right? That's not going to get a long-term trader in trouble. But a short-term trader who says, oh, I got this short-term move I'm going to take advantage of. Ooh, it went against me. Ooh, I'm going to hold it in the long-term. You can see how that could get them in trouble very quickly. And that is one of the biggest mistakes that I see day traders run into when day traders approach me and talk about different things. And it sounds so easy to stay out of. You just say, hey, you know what? Just get out. But it is so easy to justify and to say, well, hey, I short term, but I'll hold it for the long, and get yourself in trouble there. And that's why the discipline is absolutely necessary when it comes to day trading. Now, there are times where I will go and I will use short-term techniques to get into something that I like long-term. And I'll say, hey, you know what? I really like Amazon long-term. All right. You know what? When I get a nice little short-term signal, I'll use it to start getting a position, right? Start establishing a position. And nothing wrong with that. But I'm also not day trading, right? I'm using a day trading technique to establish a long-term position that I like, which is not day trading there. But when you get in, you're just in a day trade mentality and you decide, hey, I'm going to now hold this. There's a lot of trouble that can come from that very quickly. And you can see it eat traders alive because now they're having to constantly look at it and question, what do I do? What should I do? What should I do? And if you're having to question what you should do every 5, 10, 20, 30 minutes, it's maddening. You almost need a straitjacket, an hour later, just to deal with the madness that comes from it. Okay. Now, this isn't comprehensive in terms of what you need to day trade and the day trade mentality. These are just some of the things that are the most important, some of the most basic, and things that I want you to understand in terms of where I'm coming from when it comes to day trading. Now, when it comes to day trading, getting into the nuts and bolts, getting into the execution of trades, there are two strategies that I use. There are observation techniques that I use, and we're going to go through them here today, and there are systematic techniques that I use. I do not use the systematic techniques very often. I will only use them on very volatile markets, right? Very fast-moving markets, markets that, on average, they're moving, a percent a day, which we don't have right now. Right, we just absolutely don't have right now. We'll go and we'll try to apply some of these a little bit, but when it comes to putting a lot of systematic techniques out there and saying, hey, you know what, let's use these, I need movement. Right, if I don't have movement, it's not gonna do me any good, and it's one of those where day traders in general, they're reliant on movement. And if there is no movement, right, it becomes very difficult to do and to sustain and to make happen day after day, week after week, month after month. The observation techniques, right? These are things that I've noticed over the years, that I react to over the years, and almost every one of these you will have heard me talk about in one way, shape, or form over the last 5 years, right? Most of these are nothing new. And all of these are something that I take a look at each day. But for the most part, they're not going to provide me with a trade each and every day. When they do, I love them, I take them, and I go. But when they don't, I don't sit there and try to force it. These are not things that I can go out and force. They're not things that I can say, well, it's close, should I? It just puts me into a bind, right? Well, let's start with the most common, the one that happens the most, right? And that is dealing with S&P futures, right? And what I'm going to term broken overnight range, right? Broken overnight range. So let's just go to last night, S&P futures. I'll bring up the chart here. And we have the market closed here on Christmas Eve, closed right at this. Let me get my drawing tool. There we go. The market closed right here. Okay. Now, overnight, over Christmas and last night, the market until right here. Look at the trading range on the market. The high was right here. The low was right here. That's a pretty tight range. We're talking about, a 5-6 point range on S&P futures in that time period. These ranges are nice. What do these ranges mean? Well, when the range is really tight, oftentimes we don't get a lot of movement the next day, right? You can almost look at S&P futures, and if there's a lot of movement overnight, you're going to get a lot of movement in the market that day. And if there's very little movement, you're not going to get a lot of movement. But you're also going to see some added movement on range breaks. So when S&P futures break this range, this overnight range that it had, and it did it, within 15 minutes this morning, most often the market is going to close higher than that range, right? Most often it's going to close higher than that range. Now, I choose two different ways to trade this and to be involved with it. You can either buy the break, right? You can either buy the break of the range, which I choose to do rarely, right? I choose to do rarely because many times that range break happens very early in the market day, and something that I'm just, I just kind of I'm fine with letting go, right? And I just let it go. But the easiest part is coming in and trading a retest of that range. So in the case last night, we have a retest of the overnight highs. This is a very nice buyable position. Why? Well, because now my stop makes sense, right? My stop comes at what? It comes at the low of the day, right? I put it at the low of the day and I say, look, I'm going to just hold this till the end of the day because chances are very good that the market will close higher since it broke the overnight reaction range. That's the tendency we see. So I'm going to buy a position. I'm going to buy it for the end of the day. I'm not going to buy a position, stare at it each and every minute, each and every moment, and say, what do I do with it? What do I do with it? No, I'm day trading, right? But I'm buying it here at 10 o'clock in the morning. I'm selling it at 2 o'clock in the afternoon, right? Nothing wrong with that. It's still a day trade. But these retest. So, for example, if and we'll see this happen in more bearish style markets. These are the money makers. You have an overnight range, right? You break that overnight range. You come back and retest it, right? And this tends to be a very nice short spot where you can buy some puts and you can expect the market to head lower into the close. All right. That is the most common setup, a range break, right? And you could trade the range break in two ways. You can buy the break, or you can buy a retest of the break. You don't always get a retest of the break, right? So if you're just buying retest, you're not going to get as many signals, but you will get some. I'm going to go to 5-minute chart here just so we can look at Tuesday, right? So here we have overnight futures, right, where we get a high right here and we get a low right here. Okay, what happened? Well, we get a break, right? We get a break, we get a retest. Now, did it sell off hard, or anything like that? No, it didn't, right? It didn't. This is a half day, but had the principles, had the break, right? And even on a day trader, you're losing a lot here? No. And that's one of my favorite parts about this trade is you set it up, even if it doesn't work, normally it's not going to go against you in a big way, which is something that I like. I can say, all right, you know what? It has a 50% chance of working, 60% chance of working, but what does it do when it doesn't work? Oh, it just kind of doesn't do anything. So my losing trades are very small losses. Those are the things I like. And with this strategy, it's very simple. It's very clean, and the losses tend to be relatively low around it when it doesn't work. Okay, so anyway, that's the first one, right? So this break of overnight ranges. Now, my favorite one is the high volume trender, right? So we're not seeing it happen right now, but in these situations where we get the market moving. And I'm not talking about 2, 3, 4 points, right? I'm talking about the market's moving. It's moving 0.5%, a full percent. It's been diving for 3 days, right? And it's been going down, down, down. And then we get this volume, right? And we get this volume where all of a sudden we have a volume where there's 20,000 futures contracts traded. A massive number, right? You can say we don't have anything close to that today. 7,000, 6,000, 4,000, 3,000. Most minutes are under 2,000, right? We don't have that volume. But on these days where we get a move, like even let's say today, all of a sudden we were to see upside, we see another push higher, and we see 20,000 volume, that tells me something. That tells me that the chances that the market closes higher than that level are very slim. So what can I do with that data, right? If we have down, 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 and then we have 20K volume, now I know the chances of the market closing lower than that are very slim. If we know that, now we can start to do something. And this isn't something that I sit at my computer and I go, man, I have to be there the second it happens or else I can't take advantage of it. No. In fact, oftentimes I let it happen and then give it a half hour, 30 minutes, 40 minutes. because oftentimes what we will see is this. We will see the market go down, 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 and it'll hit a big volume area, right? I'm just going to kind of circle right here. That's our big volume area. That's going to get a little bounce. And then it's going to bleed on lower to a new low, right? Just to a new low over the next 30, 40 minutes. And then it's not going to have a big volume. It's going to have some volume right here, but not the big volume that it had right up here. And then it's just going to coast on back to this level. Now, sometimes it'll break that level and go significantly higher into the close, but rarely does it close lower than this level. So I know that anytime I buy it under this level, I'm probably in a good spot to make some money. And so that's what I'll do. I just kind of wait it out, let it come on down. It's never all that easy because the headlines tend to be negative. There tends to be a bunch of red out there, and you're buying green you're buying the call in a sea of red, but it tends to work out very nicely. And it's one of those where you could take half when it gets back up to that level and hold the rest, or you can decide what you want to do. But this is one of those that's kind of like the last strategy. I'm in a position where the chances of it going against me are just very slim. And so I can be patient with it. I can ride it throughout the day. I don't have to sit there and go, well, do I exit here? Do I exit here? Do I exit here? Right? There's just more observational, more kind of just playing the feel and the context of the overall market. And when these happen, they can be very big money makers very quickly. For a trader. And you don't have to trade S&P futures. You could trade the SPY. You could trade, various ETFs. You have a stock that you've been wanting to get into and okay, the market's bottomed. Okay, now that stock, probably a little bit better entry point, though, that has a little bit more risk associated with it. But, that tends to be a very nice, way to get in. And, in more volatile markets, we'll see this happen a lot more often, right? I don't expect that we're going to see this next week. We could, going into the end of the year, we could see it, but it is not something that we have seen more than a handful of times this year. Some years we see it almost every day. Other years, like this one, we just don't see it very often. And we saw it once this month, come in. I played it a little bit, but, it's just one of those where we don't see it very often. But when it happens, it's incredibly effective. All right, so that's number 2. Number 3 is this tendency around a calendar, right? And the calendar, we have this. We have the first of each month, right? The first trading day of each month. And if we were to go and look at stocks and what they tend to do the first of the month, let me just come in here to stock charts. I'm just going to pull up a chart and clear out our indicators since I don't really care. But if we come look at the first of each and every month, we tend to see something. Right? And it's a tendency. It's not an absolute, right? But let's come to the first trading day of December, right? Here we go, right here. Let me thin this line out. There we go. Big bad red day, right? Big bad red day. All right. What about 1st of January? There we go. Pretty big rally that happened throughout the course of that day. What about the 1st of February, right? Not a whole lot. 1st of March. Got a gap up, early sell, and rally back. 1st of April. Got a gap up and continued rally. 1st of May. We got a gap up and a sell, right? What are the things that happens around the 1st of a month? And here we have June. So we'll just use these. When you look at funds, right? A lot of the money that goes into the market, it's not a fund manager saying, well, I like this stock or I like that stock, or a trader at their desk saying, oh, let me go buy a bunch of this or let me go buy a bunch of that. A lot of the money that comes in is from 401ks, from IRAs, from money that each and every month is allocated to go into the market, no matter what, right? It's money that is set to go in. And oftentimes, that money will come in at the beginning of a month. That's when most of that money comes into play. And a lot of times on the first day of the month. And so oftentimes, on the first trading day of a new month, we will see a period, whether it's a gap down, whether it's a gap up, we will see a nice little run to the upside. About 0.5% on the market in many cases, where you will just see the market all of a sudden just slow, steady upward tick, and it's a lot of that money starting to come in. Now, it doesn't happen all the time. When the market has been very volatile or very choppy or very bearish, that money can wait a day or two. That money will kind of hold off, right? We saw that in May, and we talked about it at the time as it happened. And, we saw this turn on the second trading day, and, we saw the forced money start to come in, right? It didn't come in on the first day of the month. It came in, it came in it came in on that second day. But oftentimes, if the day is down, if the first new day of a month is down, you'll see it rally into the close because that money comes in. If the first day is down, that second day of the market, you'll see, a gap down or something, and then the money come in. We saw that in December, right, where the money came in on that second day, pushed up. Here in January, it came in on the first day, market gap down, that money came on in. But we tend to see that money come on in, and it's oftentimes just a nice kind of 0.5% move in the market where you can, you look at the dip and you say, all right, you know what, we're starting to see a little upside. Let me go grab some calls and let me take advantage of it. And around the first of any new month is when we tend to see that happen. It's not one of those things where you can say, hey, the downside's limited, like with the other observational things. But it is one of those things where you're very likely to get a move in your way. And for me, it's normally not something where I just go, oh, okay, so money's coming in, let me go after it. It's one of those things where I know on the first or second of a month, I can start to look at my systematic techniques, my systems, and say, oh, am I getting buy signals on those? If I am, okay, let's go, right? And so I kind of combine the observation technique with the systematic. I say, hey, it's the first of the month, so I need to be a little bit more wary of any upside signals that come in on whatever system I want to use. Okay. Number 4. This is an event range. We see this happen a lot. And, you get this event that's going to happen, right? The Fed, right? The Fed's going to come out. They're going to release their numbers. They're going to release something. Or we have a jobs report, right? These are the two most common, the Fed and the jobs report, where we'll see the market react. And there's a couple ways to look at these. Because when it comes down to it, almost every Fed rate decision that we see nowadays does this. Market goes into the Fed happens, and we get a move. Boom. We get the move. And magically, within another hour, maybe sooner, the market's right back to where it was before that event. Sometimes it's to the upside and back to where it was before the event. But in so many of these events, whether it be jobs, whether it be Fed, we will see a move back to where the market was before the event. And so on these events, I watch them. What am I looking for? I'm looking for the events to create a market move but not to be really eventful, right? So in the case of the Fed comes out, does everything the market expected, and the market moves. Oh, it sells fine. Fed did everything the market was expecting, and the market sold fine. It's going to come back to these levels. Oh, jobs report was in line. We got a big rally on the jobs report on an inline number. No, it's probably coming right back to where it was, right? And so I will watch these events for this kind of return to where it was. And if you kind of watch these events over time, we see this happen on such a regular basis. And it's not always within minutes or even an hour. Sometimes it's by the next day. But it is just so common to see where, the peaks and the valleys, just come back to normal. And you can trade that, right? You can trade them back. But what will happen around all those peaks and valleys and back to everything is an event range will be created. We talked about an overnight range. And this is something where, you give it 24 hours. You give it 24 hours to create this event range. You have a high, you have a low. And in the case where the market's right in between its high and low of that event, now you have something. Now you can look at this in the way that we looked at overnight futures. Break on the upside, go. Break on the downside, go. And being able to trade those breaks, tends to be rather profitable, because one of the things that will happen, if you think about fund managers, they're going to see an event happen. It's going to go, it's going to look like a squiggly line across their screen. When are they going to make a decision on how to act? Well, the next day, right? They're not looking at how does this affect stocks for the next 5 minutes. They're looking at how does this affect stocks for the next year, and is this positive? Okay, then I need to allocate more money. Is it negative? Okay, now I need to pull more money off. And so these event ranges can be played. Now, the last one here is number 5. And this is one that we're going to see next week. Right? This is one what I expect to be able to play next week. But end of year sells. Now, this doesn't happen every year. But if we come and we take a look at Amazon, and let me just get rid of indicators. I have Amazon from 2 years ago on the last trading day of the year. Take a look at what Amazon did. Down, 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 down. Right? If we go back over the years and we look at what stocks do into the end of the year, very often, here's 1 year earlier on Amazon, very often they're going to sell into the end of the year, especially when the market's been up that year. Last day, last hour, we tend to see sell. Here's Amazon. This is now in 2015. Last day of the year, sell, sell, sell into the close. You see it accelerating into the last couple hours, right? We go back one more year. Here we go, into the close, right? It's a flat day for Amazon overall, but those last 2 hours, what do we see? Sell action. We go back again. And you get the theme, right? Here's Amazon. We sell in those last 2 hours. Last hour, whoops, goes the other way. We don't see that happen as often. Most of the time, we see a hard sell into the end of the year, right? Occasionally, it'll be different. Here's Amazon a year prior. Rallies during the day, last hour, boom, sell. If we go back one more year, 2011 to end of 2011, it was a little more benign, right? Go back one more year. You'll see pretty heavy sell on that day. What's the point? Well, into the end of the year, we can tend to see some moves that don't really make a lot of sense. Right? Here's another year prior. but they're on big volume and they're heavy directional moves on that big volume. There's a lot of theories of why, right? One of the more popular theories is it's tax selling, right? They want the profits locked in for that year. And then, what will they do? Well, on the next trading day, everything they sold, they'll go back and get into, right? They'll say, well, we got out, now we go get in, right? So here's Amazon, they pop on out. The next day, they jump on in, the stock gaps up, and it erases that loss. As we get into the end of the year, we can see some bigger runs happen, especially late in the day. We'll often see them happen either really early or really late, in the day. I suspect this year we could see them happen very early in the day, and one of the reasons why I want to be on, for day trading. But this is one of those where knowing this tendency, right? And saying, well, there's not really a catalyst, right? Last day of the year, no real news, nothing going on, no real catalyst, but then you can still see a strong move, right? So in this element, or in this kind of first of the month idea, right, where I go, all right, now I'm willing to apply a systematic technique and trust it a little bit more with that observational tendency. Same thing. End of year sells, even end of year buys. I'm not willing to just go out and say, well, let me go buy Amazon puts because it's going to sell off into the end of the year. No, I need to see some sort of technical basis for it, right? Some sort of systematic technique also confirm that. But when I get that confirmation, I'm ready to run, right? I'm ready to go. And so tomorrow we'll talk about these systematic techniques, and we will be applying them into the end of the year sells, here that we see. But any of these happen, over on Monday or Tuesday, we will take advantage of them. We will go with them, and we'll talk about them happening in real time. And then the systematic techniques, I'm going to show you two of them here tomorrow. Those are the two that we'll apply, and we'll run from there. Again, I hope you're having a fantastic holiday season. Wish you all a Merry Christmas and a Happy Holidays and a Happy New Year. And looking forward to a great start here to 2020. Have yourselves a great one, and we'll talk to you later. Take care.